Hey everyone, welcome back to the channel. Today we're going to unpack the Federal Reserve's recent interest rate cut, its first in over 4 years, and explore how these decisions impact the economy and the stock market. Let's dive in. First, let's talk about how the Fed's rate cuts affect borrowing costs and consumer spending. When the Fed lowers interest rates, borrowing becomes cheaper for everyone, businesses, consumers, you name it. Banks pass these cuts down to us by reducing the interest rates they charge on loans and mortgages. This means that if you want to buy a car, a house, or even finance a business, it'll cost you less in interest. Now when borrowing gets cheaper, people are more likely to take out loans and spend money. This increased spending boosts economic activity, which helps drive growth. For example, if more people are buying homes or cars, companies that build homes, manufacture cars, or supply materials to these industries see a surge in demand. This stimulates production, hiring, and overall economic growth. In the case of the Fed's September 2024 rate cut, the goal was to prevent the labor market from slowing down too much. There were signs of a potential increase in unemployment, and the Fed wanted to take action to keep the job market strong. Now let's shift gears and talk about business investments and how lower rates can impact economic growth. For businesses, lower interest rates reduce the cost of borrowing money to finance projects, whether it's expanding operations, building new facilities, or even acquiring other companies. This helps companies increase productivity and hire more employees, contributing to economic growth. For 2024, the Fed projected economic growth to stay at around 2.1%, which isn't rapid but still steady. However, rate cuts aren't a magic fix. If businesses think the Fed is cutting rates because the economy is weakening, they may hold off on major investments waiting to see how things play out. So, while rate cuts make borrowing cheaper, they don't always guarantee a surge in business spending. Next up, let's talk about inflation and the Fed's dual mandate. One of the Federal Reserve's key responsibilities is controlling inflation, which leads us to their dual mandate, keeping prices stable while also maximizing employment. Inflation in 2024 has been cooling off after hitting a 40-year high in 2023, but it's still running a bit above the Fed's target of 2%. Cutting rates can help keep the economy growing, but it also risks reigniting inflation if demand rises too quickly. In simple terms, when people and businesses borrow more, they tend to spend more. And if spending ramps up too fast, prices could start rising again, leading to higher inflation. That's the delicate balance the Fed has to manage. That's why even though the Fed is cutting rates, they've made it clear they'll adjust their policies if inflation starts picking up again. They're playing it cautiously, trying to boost growth without overheating the economy. Finally, let's talk about how all of this plays into the stock market. Rate cuts don't just affect borrowing and spending, they also have a big influence on stock prices. When the Fed cuts rates, stocks often get a boost. Lower rates make borrowing cheaper for companies, which can increase profits and future cash flows from those companies become more valuable. This makes stocks more attractive to investors, especially compared to bonds, which tend to have lower yields when rates drop. But, and this is a big but, the reaction is not always straightforward. After the September 2024 rate cut, major indices like the Dow Jones Industrial Average were all over the place, fluctuating between gains and losses before finally closing slightly down. Why? Because while some investors welcomed the larger-than-expected cut, others were worried. They feared the Fed might be signaling deeper economic problems ahead, and that's not something the market likes to hear. So while rate cuts can often drive stock prices up in the short term, there's always the risk that they're a sign of economic trouble, and that can make investors nervous. So, to sum it all up, when the Fed cuts rates, it lowers borrowing costs, which can boost consumer spending and business investments. But it's a double-edged sword. There's always the risk of reigniting inflation or signaling economic weakness. The stock market typically likes lower rates, but as we saw after the September 2024 cut, the reaction can be mixed, depending on how investors interpret the Fed's moves. Thanks for tuning in to today's breakdown of the Fed's rate cut and its impact on the economy and stock market. If you found this video helpful, be sure to give it a thumbs up and subscribe to stay informed on all things finance and economics. See you next time.